Imagine this, your friend tells you they made 20,000 pounds from crypto. Another friend says property made them a millionaire. Then you see someone on TikTok claiming they make 500 pounds a day trading stocks. Suddenly it feels like everyone around you is getting richer. So you start thinking, maybe I should be doing the same thing. But here is the problem. Those stories might actually be the worst possible way to make financial decisions. And there is a name for this mistake. It's called anecdotal fallacy. And it quietly causes people to lose thousands of pounds in investing. The anecdotal fallacy happens when people rely on individual stories instead of actual evidence or data. Instead of asking, does the data support this investment? People ask, did someone I know make money doing it? Humans are wired to trust stories. A story about one person making money feels more convincing than statistics about thousands of people. But in finance, this is extremely dangerous because investing success isn't about one person's experience. It's about probabilities over time. Behavioral economists like Daniel Kahneman shows that humans often make decisions based on emotions and stories rather than rational data. And nowhere is this more obvious than in investing. Let's look at a few examples. You might hear someone say, my colleague bought Bitcoin in 2017 and now he owns 2 properties. That sounds incredible, but what you don't hear about are thousands of people who bought crypto at the top, lost money in speculative coins, panic sold during crashes. The success stories spread, the failures stay quiet. This is known as survivorship bias. Out of thousands of people trying something risky, the few winners become very loud online. They are not the typical outcome, and if you base your financial decisions on these stories, you are essentially gambling. I actually experienced something similar myself. Few years ago, I kept seeing people online talking about easy money through eBay selling and dropshipping. There were online videos and online posts claiming you could build a passive income stream and make money while you sleep. So I tried it. I started selling items online, experimenting with dropshipping, and the reality was very different from the stories. It wasn't passive at all. There was consistent work, customer service, returns, product sourcing, pricing competition. It required consistent effort and attention. The success stories make it sound easy, but those stories didn't show the actual day-to-day reality. That experience really opened my eyes to how misleading anecdotal success stories can be. This exact pattern happens everywhere in finance. For example, property investing. You might hear someone say, my uncle bought a house in London in 2005 and now it's worth 5 times more. But that story ignores several things: timing, interest rates, location, leverage risk, economic conditions. Another common example is day trading. Online, you will consistently see screenshots of huge trading profits. But what you don't see online is that most traders actually lose money over time. The internet amplifies the winners, but the losers disappear quietly. Even legendary investors like Warren Buffett have repeatedly warned that successful investing isn't about chasing exciting stories. It's about discipline, patience, and long-term strategy. Unfortunately, those things are far less exciting than someone claiming they doubled their money overnight. Our brains love stories. Stories are emotional, they are memorable, and they feel relatable. Statistics, on the other hand, feel abstract. So when we hear about someone making fortune from a certain investment, our brain immediately thinks, if they can do it, maybe I can too. But what we should really be asking is, how many people tried this and failed? Because in investing, the average outcome matters far more than the best outcome. Good investors focus on data, not anecdotes. They look at things like long-term historical returns, diversification, risk management, probability over time. For example, historically, broad stock market indexes have produced consistent long-term growth over decades. That's not an exciting story. It doesn't go viral on social media, but it's how most long-term wealth is actually built. Slowly, consistently, and boringly. So the next time someone tells you about an incredible investment success story, pause for a moment. Remember that one person's experience does not equal to evidence. In finance, stories can be inspiring, but data should guide your decisions. Because the biggest investing mistakes often start with a simple sentence: my friend made money doing this. If you want to learn more about how behavioral psychology affects your financial decisions, consider subscribing. Because understanding how we think about money might be just as important as understanding money itself. Thanks for watching, and I will see you in the next one.